Imagine the government of Kenya or a big multinational such as Safaricom or Equity Bank coming to you and saying, I'm a bit low on cash and I need to build some new roads or I need to expand my infrastructure. Do you think you can lend me some cash? That is what a bond is. It is an official I owe you. You are operating like a bank. Instead of you borrowing the money, you are lending the money to the corporation or to the government. Now, you aren't buying a piece of the company like we do in shares. You are only lending them money for a period of time. You are the bank. You are the one lending the money. Now, what's in it for you? Why would you do it? There are two major reasons. One is what we call the coupon or the interest. Now, the government tells you, I'm going to pay you every 6 months for the interest of the money that you have lent me. In 2026, for instance, some of them have an interest of between 14 and 16%. The second reason why you would invest in bonds, why you would lend to the government, is because you are going to get the principal after an agreed period of time. It could be 5 years, it could even be 10 years, sometimes even up to 15 years. Now that principal is guaranteed. Well, of course, the government will give lower interest rates because that principal is guaranteed. The government can always tax people more or print more money in order to pay you if things went wrong. Now, bonds in the corporate world have a higher interest because the risk is higher. When you lend to the government, there is no risk. If the money market fund is the waiting room, then the bond is the foundation. It is for the person who has this amount of money which they are not intending to use for a long period of time, and they want a guaranteed paycheck after every 6 months without the stress of the stock market. Now, the best part, infrastructure bonds from the government are tax-free in Kenya. That means that the government doesn't take anything from your profits in form of taxes. Now, the biggest risk in the world of bonds is the interest rate risk. Now, if you bought a bond today at 12%, for instance, then the following year, the government floats another bond at 16%. It means that you are stuck with your initial 12%. If you try to sell that bond before it matures, you might have to sell it at a discount that is less than you bought it for. There are two types of bonds: treasury bonds and corporate bonds. Now, treasury bonds are bonds or loan to the government. Corporate bonds are loans to companies or corporations. Now, I'm going to give you 3 reasons why you might want to consider bonds as an investment. One is that you have a predictable income. Now, unlike dividends from stocks, which might be cancelled, bond coupons are a legal obligation. They must be paid at the agreed time. Number 2 is capital preservation. If you hold a bond until maturity, you get your initial investment back in full. That is assuming there is no default. Number 3 is the secondary market. You don't have to wait for the 10 years for the bond to mature. When it is completely unavoidable, you can sell that bond to another investor at the NSE. That is if you need cash urgently. Now, with the government, you have treasury bills or treasury bonds. Now, what is the difference between bills and bonds? Treasury bills are short term, but bonds are long term. They will take between 5 years, 10 years, 15 years, and so on and so forth. So, in short, bonds are loans that you give to government or corporations with a guaranteed payment of the interest every 6 months, and of course, the principal on maturity, which is the agreed period of time. Now, would you consider investing in bonds or bills? Let me know in the comment section.